Dear students, once again we are here to share with you the module which is based on the working capital management. We have already discussed the broader concept of working capital, the gross concept, net concept, and how they are very useful in determining the working capital which is just sufficient to meet its current obligation, and also it is also resulting in some return or profitability for the company. Now, we know that based on the gross concept of working capital, there are three important variables, there are three important component of current asset. One is the cash, second one is the receivables, accounts receivables, and third one is the stock or the inventory. So, if the company wants to manage working capital, then naturally it has to manage the cash, sundry debtors or account receivables and the inventory efficiently. So, now this lecture number 2 is focusing on the management of cash. Why cash is important for any business? No, sometime company may have profit, but company may not have the cash, but the payment can be made only when company has enough cash to pay to the supplier of fund, to pay salary to the employees. So, the management of cash is very essential for the survival and growth of the company. So, in this lecture I am going to discuss the motive for holding cash, the managing cash flows, determining the optimal cash balance in any company, and the different models which can decide or which can estimate the optimum amount of cash at a given point of time, and then if there is a surplus cash available in the company, how to invest this surplus fund so as to have a trade off between the liquidity and the profitability, and finally how to manage the marketable security. So, there if we go by the concept of cash management, it is essential for the successful operation of the production cycle. Any firm seeks to receive cash in shorter possible time, but does not retain it for longer, because that will entail additional cost to the firm. That means, if the company wants to increase the speed of cash inflows, it would like to receive cash as early as possible, but even the payment has to be made, company would always be interested to delay the payment of cash to the outside party, and that is the way in which company can maintain a reservoir of cash to meet its day to day requirement. Now, there can be different needs for a company, including the transaction needs, need for the precautionary motives, and also sometime company wants to take the opportunity of increasing the return by making some investment, and sometimes this investment may be a speculative investment. But yes, that is true, any company can be dependent on these three motive for maximizing the value for the shareholder. Let us start with the motive for holding cash in detail. The primary goal of cash management is to see that there is enough cash in the company. Why this enough cash is required? It is because of the three important business operation. Number one is the transitory or the transaction motive. Transaction motive is where company has to deal with so many outside parties like the supplier, the laborers, and for making a payment to these party, company should have enough cash. So, these are the transaction motives. Then comes the precautionary motive. Precautionary motive actually indicates a situation where company is not knowing the accurate demand for cash. So, that means it has to keep a safety stock of cash, it has to build a reservoir. So, that is the precautionary motive, and suppose company do not have enough cash and it has to immediately borrow it from the market, then naturally the cost of borrowing the fund would be very high. So, precautionary motive would always ensure a sufficient amount of cash, minimizing the operating cost of cash which is borrowed at a very short notice. Sometime to have a very good relationship with the bank, because the bank will be interested in the very sound liquidity position and financial health of the company. So, just to have a relationship by building a image of the company in the eyes of these institutions, company have to have the cash with them. And as we have just discussed, the speculative motive actually refers to the condition of investing in those stock which is promising a very good return in near future. So, for that reason also company may have some cash with it. Now, how to ensure that the cash management is always increasing the creditworthiness of the company, and it is also ensuring that the operation of the company is running smoothly. So, this can be ensured by following 4 strategy, and these strategies includes: number 1, for managing the cash flows, strategies of projecting the cash surplus or cash deficit for each period of planning horizon. Third strategy focuses on determining the optimal cash balance, which is neither too high or too low. And finally, investment of surplus funds where it can get the benefit of marketability, safety of fund, taxation, and also good amount of return. So, here we would discuss all these strategies one by one. So, number 1 strategy is formulated in every company to see that the cash flows are coming in a way that every time company has the reservoir or buffer of the cash. And how this can be ensured? It is by following the 2 important way. One, the method for accelerating the cash flow, that means speeding the inflow of cash as much as possible, and the second part of the strategy highlights then resorting on every method which is going to slow down the cash outflow, or they are going to delay the payment to the outside party. So, this method of accelerating the cash inflows can have these strategies like quick deposit of customers' check. So, we can instruct the customers to deposit their checks as early as possible, and then the customers can also be instructed to give the check to the different agents who are there in the market, and this collection centers which is established at different point of location can speed up the collection of the checks as well as the cash. Then just like the other method, there is one method which is known as a lockbox method. Actually, this is an arrangement with the post offices where the customers can be instructed to deposit the checks in the local market using the facility of lockbox. Then the method of accelerating the cash inflows can also involve setting a maximum limit which a company will pay at one time. So, this can reduce the speed at which the cash is flowing in and flowing out. The slowing cash outflow may involve the strategies like delaying outward payments. So, here if the company has to make payment to the outside parties, it would like to delay as much as it is possible. How the company can will come to know what is the sufficient time up to which company can take this leverage or company can take this benefit. It is naturally which is not going to hamper the credit worthiness of the company. Then company can also slow down the disbursement by using the draft. So, instead of making cash payment, company can take the benefit of using the draft facility. So, when the draft is made, the company cash balance will not get affected unless and until the draft has been collected or it has been presented for the collection purposes. Then making period less frequent. So, when the company has to pay to the employees and to the laborers, then it can decide that at the end of every month it is going to pay, and in that condition company would not require to make the cash balance throughout the month. So, only at the end of the month when the payment has to be made, company can have the enough cash in its account, otherwise it can invest all these idle cash in some good profitable opportunity. Using float is also a mechanism by which a company can take the benefit of difference in the point of time when the check is signed and actually it is being accepted and collected by the customer. Company can also keep all its cash in one bank and when the payment has to be made. So, these strategies are actually helping the company to speed up the process of cash inflows and slowing down the process of cash outflow, so that company has enough cash and it is not in hurry or it is not in urgency to take the or to borrow the funds at a short notice, because the interest of rate of interest may be higher. Now, I am giving a hypothetical situation where the company can decide to keep the cash balance in the bank of the company. This is 2, 10, net 30. So, in that case company can decide either to make payment on 9th day. Why 9th day? Because this 2, 10, net 30 term actually referring to the provision of 2% discount if the company makes payment within 10 days. So, company can pay on 9th day to avail the benefit of 2% discount. So, this discount is available if the company pays on 9th day, but if the company has not been able to take the benefit of this 2% discount, it is always in the interest of the company to make the payment on 29th day, because between 10 to 29 days company is not going to get any benefit of discount. So, this is the wise decision of the company to either pay on 9th day or to make full payment on 29th day. The second strategy is focusing on the process of determining optimal cash balance, and here the appropriate level of cash balance is required to optimize cash utilization and to decide the level of investment for the marketable securities. So, actually there are two options before a company, either to have a cash balance or to invest in a marketable security. So, one is for liquidity and this is for the increasing profitability of the company. So, this optimal level of cash can be decided on the basis of transaction balance, how much cash is required to fulfill the transactions, and secondly the cash balance which is required to meet out any emergency or any requirement that has been restricted or stipulated by the commercial bank. So, for these different points would actually help a company to decide what is the optimal level of cash which needs to be maintained by a company. And here to rescue the company, there are two models. One is known as the Willed Inventory model, which was invented by William Baumol, and this is also known as the EOQ, that is economic order quantity model, and second model is stochastic model. So, these two models actually used in two different situations. Inventory model is used when the demand for cash is known with certainty and accuracy, but the stochastic model is used when the demand cannot be ascertained, and so company can only decide about a range within which the cash balance should lie. Let us see the assumptions and the formula of the inventory model. The inventory model for cash management is used for determining the cash holding required by the firm, and the assumptions under which this model can be used include the demand pattern and the lead time are predictable. Second is the ordering cost and holding cost, they are constant, they are not fluctuating with these different situations. There is no supply chain disruption or sudden market shift, that may as and when the cash is required, company can take it from the market, and the safety stock calculations are based on the historical average, that means the past experiences are helping the company to find out the optimal balance. The formula is the Q, that is the standard or the optimum size of cash inventory, is equal to under root 2 CB divided by K. Here C stands for average fixed cost of securing cash from market, that means the ordering cost of cash. B is the total amount of transaction demand for cash over a period of time, and the K stands for cost of carrying inventory of cash, because when the cash is kept idle, company is actually foregoing some interest. So, that is the cost of carrying the inventory of cash. So, with the help of this practical question, let me make you clear how actually the inventory model helps to calculate the optimal size of cash. XYZ Limited is estimating a cash payment of 4 lakhs for a 1 month period. Then the average fixed cost for securing capital from the market is 1000, that is per order, and the interest rate on marketable securities 12%, or that means 1% for the 1 month period. Now, putting the formula into this problem, we can calculate the optimum size of cash that should be maintained in the company. So, this is under root 2, this is the fixed cost for securing capital from the market, this is the the balance that is to be maintained, and this is the cost of carrying inventory. So, by solving this formula, we get this 2,82,843, that is the optimal transaction size of the company. That means every time when company is going to procure cash from the market, this should be the size at which the total cost of maintaining cash and ordering cash would be lowest, and as a result the average balance is nothing but the 1,41,421. So, this is the inventory model. Can we discuss some of the advantage and disadvantage of this model? It is very simple. Just by estimating the demand for cash, the ordering cost and the carrying cost, we can calculate the economic order quantity of the cash. It is also helping company to minimize the ordering and holding cost, because you see this is the cost, this is the size of cash. So, if you place frequent order, then it will be very high, but if you are going to increase the size of cash, that means you are keeping a high amount of cash at given point of time. So, ordering cost will come down, but as you increase the size of cash in your company, the carrying cost will be higher, and this will be the total cost. So, the total cost would be minimum at this point, and this is nothing but the economic order quantity, or this is the optimal size of the cash that a company should maintain at any given point of time. So, this is the inventory model, which is the structure is very rigid, because in volatile market we cannot be 100% sure in predicting the cash demand, and if there is a fluctuation, this model would be of no help. And conservative bias, that we often go with the principle of conservatism, where we overstock just to see that enough liquidity is ensured in the company. This may create problem of reduced profitability in the company. So, real time data and macroeconomic shift cannot be incorporated in this model. Now, as against this inventory model, a stochastic model would follow the assumptions like market volatility, follow historical pattern. There are multiple economic scenarios. This just can't be one scenario which can be predicted with a high amount of accuracy. There would be demand fluctuations. So, we need a different model, and the formula for knowing the optimal size of cash is like 3 under root 3b. This is the variance of daily net cash flows. B stands for fixed cost associated with the security transactions, and K is again the interest rate per day on marketable security that company would be foregoing if it is going to maintain the stock of the cash at a very high level. Then I can also discuss one of the model given by Miller-Orr. This is also known as a stochastic model, and you can see in this presentation that there is a particular line, this is called the return point, and the company has set the upper limit to have the cash, and the company has also set a lower limit of having the cash in the company. This the fluctuating amount of cash is actually denoting the real picture of any business, because cash cannot be predicted with high amount of accuracy. So, according to this model, company can only set a limit. So, when the cash balance is reaching to this upper control limit, then company has to purchase these securities, and this is how the cash is converted into the marketable securities, and the cash balance will come to this point. And when the cash of the company is reaching to this lowest point, according to the company's policy, company would sell some of the market security to again revert the cash balance to this point. So, this is the normal line which should be maintained by any company, and these are the two controlling limit, upper limit and the lower limit. So, this stochastic model actually is not giving you one exact figure up to what company should maintain the cash inventory, rather it is giving a zone where the cash balance of the company should lie. The evaluation of a stochastic model can be discussed in the term like there are certain challenges, that is estimating transfer cost, holding cost, and how many transfers are required of the in the company. Then average cash balance is difficult to predict, and that is how the stochastic model is very helpful for any company. It is good for all those managers who are aware of the risk inherent in their business, and it is also helping the manager to adjust with the real world uncertainties like the supply chain delay. And company can also align its liquidity and the profitability scenario with the changing circumstances. But as we know that this requires a lot of calculations, and so advanced tools like economic scenario generator they are required, which makes the process very complicated. Intensive data is required. It is very expensive to set up and maintain the process of calculating the optimal size of cash inventory, and this may also sometime over emphasized on the past pattern and may underestimate the emerging trends. Then the last segment is related with the management of marketable securities, where there are two important dimensions to be analyzed. One, how much amount to be invested by the company, and yes, if it is going to invest, what are those securities where the company can make the investment. So, there are certain principles which can help the company. Number one, whether the cash flows are predictable or not, and secondly, if the company strategy is less effective when cash flow patterns are uncertain. In such case, the maturity diversification is advisable. Staggering investment maturities to ensure a steady stream of cash becomes available at different point of time. So, here company can invest in some securities which is having a maturity period of say 1 year, another pool, another group of security can have a maturity period of say 2 to 3 years, and there are some securities which is getting matured after 5 years. So, this is going to give a guarantee to the company that every period interval is generating or having some amount of cash available to the company. So, this diversification principle with respect to maturity is a very nice concept, is spreading the maturity period over a different time horizon and making it possible for the company to fight with the problem of illiquidity. Then investment of surplus fund is also an essential strategy for any company. So, how to invest the surplus fund and how to choose the securities, and there are certain principles that should be kept in mind. One is the marketability. Marketability sold out in the market, they can be converted into cash without any significant delay and without any significant loss. So, security should be such which has very high level of marketability, that means the buyers are available. So, when company wants to sell it, it can be sold out in the market. Now, the company would also not like to take much risk when it is going to invest its cash. So, safety of the investment is important, and here all the government bonds, municipal bonds, they enjoy a very high credit rating as far as the safety is concerned. Maturity, we have seen that there has to be a diversification of marketable securities in terms of their maturity, ranging from less than 1 year to more than 5 years, and the taxability is also very essential feature which should be considered while selecting marketable securities. So, any security which is offering tax incentive should be given priority over the one which is not giving such exemption to the investor company as an investor. So, all the important government securities normally offer the tax incentives. So, that should be the preference of any company while selecting the security for making the investment. So, these are the strategies that we have discussed here. Number 1, how to economize the cash by accelerating the cash inflow and slowing down the speed of cash outflow. Then the strategy has also highlighted how to select the particular model which can help company to find out the optimum size of cash inventory, neither too high which is hampering the profitability, nor too low which is actually creating the problem of illiquidity in the company. Then the strategy has also indicated some of the very important points in selecting the marketable securities, and where the principles of marketability, safety, maturity and taxability have been discussed. So, with this I hope the first component of current asset and the working capital, that is the cash and near cash item, have been discussed. I hope you have enjoyed this journey, and if yes, there is any problem, we would like to solve it with our efforts and your dedication. Thank you so much.